All right. So, let's talk about some ways that you can reduce your tax bill for the upcoming tax season because it is December. You got about 3 weeks left before it's January, and all your opportunities to decrease the amount you pay in taxes run out. So, before I go into this, I'm just going to let you guys know that really to increase your tax refund or decrease your tax bill, you have to spend money. These are what I'm going to go over are tax deductions. So they kind of work like an expense against your income. You get to write it off on your tax return. But like I said, you have to spend this money to get a bigger refund. But in some instances, you might want to be able to do that because you give less money to the government and there's kind of more money in your pocket. So, item number one, this would be increasing your contributions to your 401k, 403b, or traditional IRA, not a Roth IRA, a traditional IRA. So, either increasing your contributions for these last 3 weeks or just taking a lump sum and plunking it down into one of these accounts, okay? So for this, you can write that off. You can write off your 401k, 403b, and traditional IRA contributions on your tax return. And when I say write off in a deduction, kind of works like think of yourself as a business kind of, and you're taking an expense against your income. So let's say you made 35 grand this year, you put in 5 grand to your 401k, your income goes down to 30. Okay, so all of these things that I'm going to explain work like an expense against your income. It reduces your total income in which you'll be taxed on. So the first way, increase or put a lump sum down on your retirement contributions, 401ks, 403bs, and traditional IRAs. Put some money in there. If you haven't met your company match yet, you maybe have a little bit of savings, kind of money, you're sitting all right financially, chunk some money away into those accounts. Could probably get a bigger tax refund that way. So that's way number one, increase a retirement contribution amount. Way number two, students out there who have student loans, or you graduated college, or you went to college, took out a loan, figured out college wasn't for you, and there you are repaying your student loans for the money that you borrowed. Your student loan interest is tax deductible. You can write that off on your taxes. You should be able to go to your student loan services account online and print off the form. I can't remember the form name exactly off the top of my head right now. But you go onto that account and you should be able to print off that form, which will show you how much you've paid in student loan interest. Or you might get one in the mail. So maybe, like I said, kind of the same. You got a little bit of extra money laying around. Throw some more money at these student loans. Pay off some more interest, and then you can write that off on your taxes as well. So that's way number two. Way number three, this is actually a lot less common now than it used to be. This only goes for people who are able to itemize your deductions, which recently became a lot harder with the new tax code. It's not necessarily bad, just a side note, because you either get the better of the two, a standard deduction, or your itemized deductions. Whichever is better for you tax-wise is the one that you take. So just because you cannot write off your mortgage interest, property taxes, and things like that on the itemized deduction sheet does not necessarily mean that you are worse off than when you could, because you get the better of the two, itemized deductions or the standard deduction. That's a side note. Anyways, but this third way is a lot less common, and it's donating to a charity. If you are able to itemize your deductions, then you can donate to a charity and write that off as well on your taxes. But that's only if you can itemize. Not saying you shouldn't donate to charities, you still should, but the tax benefits involved with that became a lot less, considering the fact that lower income to lower middle class people can't itemize anymore. So that was way number three. Way number four. If you at work have a HSA, health savings account, money put in here contributed to this HSA is also tax deductible. You can write off these amount on your tax return as well. So I'm not too educated on the whole requirements that go into how much you can contribute to an HSA or things like that. So look into that before doing it. But I do know that contributions made to the HSAs are tax deductible. Way number 5, and this is only for teachers. If you are a teacher K through 12, tune up. I'm sure you've already heard about this if you are a teacher K through 12, but you can have $250 of your educator expenses. So this would be things like supplies that you bought for your classroom, whatever that might be. Up to $250 of that can be written off as an expense on your tax return. If you're a teacher, you've probably already heard that before, but in case you didn't, there you go. And it's a way to reduce how much you're paying in taxes and increase your refund. So teachers, if you have a little bit extra money, maybe buy some classroom supplies, but it's only up to that $250 limit. You can spend $500, they don't care. They're only gonna let you take the $250 write-off, okay? It's just the law. So that's way number 5. Way number 6 is if you have a stockbroker account. Now, this does not go for the stocks or mutual funds that you have in a retirement account. This is only if you just have a regular stockbroker account. Maybe you opened up something on E-Trade or things like that, and you buy and sell stocks. If you are sitting on a stock right now that has a loss, sell it. And then investment wise, you could buy it when the new year comes. So you sell it now, and then first week of January, buy it again. Okay, investment thing to give you a tax benefit, because you can take those losses, you can deduct those losses in your investments on your tax return. All right. So say you're sitting down with a $500 loss in a stock that you invested in, sell it. You can write that $500 loss off on your income, and then if you still think it's a good investment, buy it again in January. That way, you get your tax write-off, and you pretty much still enter in at the same spot you were in before. Okay, so that's way number 6.